Hi everybody and welcome back to the Peregrine Capital Hedge Fund Training Academy. My name is Alan Yates. I'm the head of distribution for Peregrine Capital, and today we're going to be talking about hedge funds, perception versus reality. So I can tell you that when I joined this industry, I had all of these preconceived ideas in my head. And I thought hedge funds were a space where guys were taking a lot of risk, where the fund managers were looking to generate these outsized returns, geared up to the market exposure, that was really just for the ultra high net worth individual. It was an elite industry that seemed very shrouded in mystery to me. I also thought that hedge funds, as an aside, had that image of being kind of the hot, hip and happening party spot. And when I joined Peregrine Capital, I must tell you, I was somewhat disappointed to find out that this was actually a selection of massive nerds talking about mathematics and things of that like on a daily basis. So let's dive in now to a couple of the myths, and hopefully we can get through those today. So the first thing that I think a lot of people think about when they think about hedge funds is fees. And we've actually done a module on fees specifically in this course, so I would suggest you have a look at that for more detail. But I think a big perception around hedge funds is that there is this big fee structure to them, it's a complicated fee structure, and that they are expensive. And the way I would suggest people should look at that is to say, what are they getting for those fees? Absolutely, hedge funds are going to be more expensive than your passive index tracking funds out there. We are active fund managers, and we're active fund managers with a wide mandate. And that mandate gives us many tools in the toolkit, but that means that we have to have the right bums in the seats, right people with the right experience that know how to manage these things, that know how to utilize these things to generate those returns for our investors, how to manage risk, how to construct those portfolios in thoughtful and clever ways. And I think that is just super important for investors to think about when they look at any hedge fund manager. Tell me about the track record of that fund manager. Tell me about the experience, the quality of the team. They need to be making sure that they're employing people who know what they're doing in this space, because it is a very different space to the long-only world. As a long-only manager, you are constrained. As a hedge fund manager, you are not. But with that lack of constraint, certainly there is a requirement that the quality of the fund manager and the quality of the knowledge of the fund manager steps up significantly. Anyways, I digress. Back to the fees. So when we talk about fees in hedge funds, two parts of the fee that I think are super important here. There's a management fee, which is exactly like all the long-only funds that you are used to. That's your annual fee that gets charged. The second element of the hedge fund, and I think this is where the conception of expensive comes in, is what's called a performance fee. Now, a performance fee really is based on performance. It is a fee that the fund manager earns only if they perform well for their investors. So often if you look at the fact sheets of a hedge fund and the TIC or TER on that fact sheet is high, that means that fund manager has actually delivered really good returns for his investors. And so what I would urge for everyone that's watching this is just to think about, am I getting value for those fees? High fees should be high value. And if that is the case, then investors often aren't upset about paying those fees at all. I mean, I often tell people that I have this fee conversation very often at the start of a relationship with an investor. You've got to get them comfortable with the fee structure. You've got to get them understanding of the fee structure. And the big part of that is to make sure that they understand that the fees align our interests with yours. If we are charging a performance fee, it means that we have to perform in order to get paid. And I think that's a powerful incentive for us as fund managers to make sure that we're doing our jobs well. Incidentally, though, when investors have been with us for a while, I never have the fee conversation because they're getting value for what they're paying. I think it's a very important concept for everyone to be aware of, is that these fees are not fees that are applied whether the performance is there or not. They are applied only if we perform, and only if we perform for that investor. An investor that comes into our funds now is not going to be paying for performance that was experienced by someone else. They will pay the performance fee based on the experience that they have in our funds. The second element that is often a bit of a misconception is that hedge funds don't add value. How could they add value? They invest in exactly the same asset classes that your traditional fund managers invest in. And I think that's very much a misnomer for two reasons. The first is because the hedge fund manager comes with a very different frame of mind when looking at markets. We're not benchmark cognizant managers. We're not looking to outperform the all-share index or outperform the S&P 500. And by outperform, I mean if the index is down 20 and we were down 15%, that is still outperformance. That's not what our investors are looking for, and that's certainly not how we approach our job. Our job as fund managers is to add true value to portfolios, regardless of what the markets are doing. And what that means, very simply, is that we think in absolute return basis. We want to make sure that we are generating those returns for our investors regardless of what the market is doing. And because, as I said earlier, we are active managers, an active manager's job is to produce alpha, to produce excess returns above the benchmark, above whatever investment universe they're invested in. And for a hedge fund manager, that means that we have to utilize that wider toolkit that brings things like downside protection into the portfolio, the ability to hedge, the ability to make sure that we are filling a portfolio with different revenue producing assets. So the income streams that come, the return drivers in our portfolios, should be very different to the return drivers of your traditional asset classes. Even though the funds are made up of those asset classes, the fact that we can do these things and have this flexibility means that we need to be delivering on those returns for investors in a very consistent manner. Third part that I think is often a misconception, particularly on hedge funds in South Africa, and I think this comes mainly from the perceptions that are created in unregulated markets like the US, is that hedge funds lack transparency and lack oversight, i.e. there's not good regulation. That's just not the case in South Africa. I think one of the fantastic things that the FSCA has done is that they incorporated hedge funds into the CIS mix back in 2015. And what that means is that we are now all regulated collective investment schemes. So the rules that apply to all the fund managers and all the funds that you are traditionally investing in for clients apply to us as well. So there is good governance, there is good oversight, they are well-regulated vehicles. And to make sure that we are delivering on that promise to our investors, we as fund managers often go above and beyond what is required of us by the FSCA to make sure that we are providing that transparency, to make sure that we can, at the end of the day, stand in front of investors, explain what we do in a way that makes sense to them. It's the reason we're doing these videos for you right now. We want to educate the industry about these funds, particularly because we think they just offer exceptional value to a portfolio. I really do believe, I joined this company because I think these funds can really add an additional quiver in the bow for financial advisors, that they can add real value to clients over the long term. But in order to do that, we have to educate. We have to make sure that you guys are comfortable with what we're doing, that you understand what we're doing, and you see the value from us. Another element of hedge funds that's often mistaken is around risk management. And I think, again, this comes from news reports, particularly around American hedge fund managers, because truthfully, a lot of them do have a very different style to South African hedge fund industry. I think the South African industry was born out of the concept of a hedge fund being a hedging vehicle. It should do what it says on the tin. Whereas in some other markets, you'll often find that a hedge fund is really just a vehicle for geared exposure to the overall market. And there's certainly a place for that, and I'm not suggesting that there isn't. But I think that most of the fund managers you'll deal with in South Africa in the hedge space, we view that downside protection, we view that risk management as actually being the core component of what we do here. We want to make sure that we are bringing different returns to investors, low correlation to investors, and downside protection to investors. And that's certainly what our investors come to us for. I think they're very, very cognizant of the fact that in a lot of their portfolio, they're going to have full exposures to the markets. They are going to hopefully feel all the good upside that they will get when markets run, but they're going to have to suffer through the downside as well. And that's the nature of the beast, and there's nothing wrong with that. But hedge funds bring something different to the table in that downside protection element. And I think that is something that is actually really important about the South African industry. So often you talk about things like leverage, gearing, etc. with relation to hedge funds. And if you look at the average leverage and gearing ratios in the South African hedge fund industry, particularly in the retail funds, first of all, there's that additional layer of regulation from the FSCA in that we are limited in the amount of gearing that we can implement in any one portfolio. And that's a good thing. That means that the regulator is making sure that investors are well looked after and they're investing in products that are appropriate for them. But the second element is that actually hedge fund managers in South Africa, I think, generally are very conservative by nature. So even though the regulation, as an example, in a retail hedge fund, the regulation says that you can go up to 200% gross exposure, most of us don't go anywhere near that number. If I look at our funds, generally we trend well below that figure. So the gearing element of these portfolios is actually really conservatively managed, and I think that's super important. The second element there is that if I look at the established hedge fund managers out there, they have a long track record of being able to do this and being able to do this well. And I think that should give investors a lot of comfort. The guys that I interact with on a daily basis are very smart, experienced portfolio managers across various businesses. I'm not just talking about Peregrine Capital here. There are a number of guys that I think are exceptional fund managers that do really well in this space because they understand how to use these vehicles consistently and well for the returns that their investors are looking for. And then I think the last sort of myth that exists is that hedge funds are just for the ultra wealthy and that they are this kind of opaque, hard to access vehicle that is only for guys that in the know. And that isn't, again, just not the case in South Africa anymore. It certainly was the case if we talk maybe 10 years ago. Because the funds were unregulated, because they were relatively hard to access, I think that there was this sort of shroud of mystery that existed. But that curtain has been lifted. As funds have moved into the retail space, as they have become regulated and they have become accessible to investors, retail investors, everyday investors who are looking to put money in to work in the hedge space, there's incredible access now. If I look at the various platforms, particularly kind of the big list platforms in South Africa, all of them offer hedge and all of them offer a variety of really good quality hedge fund managers to choose from across different asset classes. So you've got the long short equity managers, you've got market neutral funds, you've got multi-strategy funds, you've got income focused hedge funds. So you really do have a good selection and ease of access. Minimums are much lower than they used to be, and they're very comparable to traditional, long-only funds. So that part is not an issue anymore. Accessibility, as I mentioned, is absolutely there. So I think our desire is certainly to democratize access to hedge funds, to make sure that they are not just the ambit of the super wealthy and the super elite, that they are not the ambit of simply institutional investors, that fund managers are available to financial advisors, and a big part of that is making sure that we do things like these education programs where we come out to you, we interact with your clients, we make sure that they understand what they are investing in, we make sure that they are comfortable with the fund manager that's managing their money. And I think that's a super important part of what we're doing at the moment. So for investors seeking more from their portfolios, more protection, more consistency, and more intelligent diversification, I think hedge funds represent not just an opportunity, but an essential tool in their wealth creation. Thanks for joining me today.